Hello, everyone. Happy Friday. Hope everyone has had a very safe and productive week. It's been a crazy week in the world, but we're not going to talk about this past week today. We're going to talk about the past year because 2020 was a year like no other for many reasons. The market had an incredible rally after a large dip, the second biggest since we've seen since 2008. But also, there's some pretty good things that happened throughout the year, such as the launch of Sectors Made Simple. So it's been an absolute pleasure to be sharing information with you all for the past 6 months in these webinars. But today I want to go back and look at not the past 6 months, but I want to look at the past year. I want to look at the past 54 weeks and figure out what happened in the market. 52 weeks, that's not how math works. 52 weeks, and I want to look at tenemos nuestros mascota. We're going to look at what's happened throughout 2020, from the beginning to the end, see what we can find in terms of reasons for the market doing what it has, and see where we are at the start of 2021. So, without any further ado, let's say hello to everyone we have with us. Hello, Francia, Chela, Silvia, Iris, my mother, Andrew, Marta, Fernanda, Eddie, Gloria, Mabel, Mario, Emelida, Berta, Nancy, Consuelo, Jacqueline, Magnolia, Veronica, Wendy, Vero, and Kike, and Irma. Hello, everyone. Thank you for being here with us. I have lots of fun information to share with you all. So without any further ado, let's get to it. Every week, I forget the correct direction. This is the correct direction. So here's what we're talking about today. We are talking about not sectors made simple, but we're going to be looking at matrices. We're going to be looking at the matrix throughout 2020. So before I get started with this, I have to give the usual disclaimer, but a special one today, because today I'm going to be taking information and telling you what I think about it. So with my opinion, I have to say this. The information that I'm going to share with you all today is meant for educational purposes only. So while I do my best and while we do our best at Sectors Made Simple to make sure all of the information that we give you on the matrix, as well as all of the graphs we use, is correct, errors can occur, and because people may take different pieces of data, like for example where we find our market seasonality information, that will change depending on where you look. So you may find different results. So just keep that in mind. And that what I tell you today is, or the analysis I do and the conclusions that I come to, are based on my personal opinions and how I view the information of the market, and should not be considered or used as financial advice. Past results cannot guarantee future performance, and please always do your research before making investment decisions. As my mom says, trust but verify is always the best way to approach your investments. And without any further ado, let me talk about what 2020 gave us. Because 2020 was crazy. You don't need my financial opinion to tell you that, but how crazy? Well, to figure that out, let's look at the market and let's look at 2020's sector rotation in a couple of different ways. First and foremost, we're going to look at market volatility. And our key indicator of that is the VIX, the CBOE Volatility Index. Then we're going to look at how different types of sectors have performed. There are some sectors that will be a little bit more resistant to change. There are others that they're a little bit more wishy-washy. They like to come with the tide and then go out with the next tide. So we're going to look at how those different sectors have done. Then we're going to compare leadership to the market cycle, so where in the economic cycle be it recession, recovery, peak, decline, where in that cycle we are, and how leaders, what that can tell us about our leaders or give us reasons for the leaders we see. Then we're going to look at seasonality. So instead of being in an economic peak, we're going to look at being in March, how being in the month of March affects sector leaders and who we would expect to be leaders during a different period. And then lastly, we're going to talk about where we are in the beginning of 2021 as for our sector leaders. Now, let's start with market volatility. This is something that many of you have heard lots about from me, but what does that actually mean? What are we looking at here? So what we see is the volatility of the S&P 500. It is a prediction of how volatile the market is going to be in the next 30 days. And the number that we see, this number over here on the right, is not a price. It's just the index value. So that number is important. If we are in a stable market with very little going on, waters are calm, we're on a nice lake, the waters are calm, then we expect for that VIX, that volatility number, to be 15 or below. Now, this was not an average year. So let's look at how volatility changed over 2020. This graph is from January 1st to December 31st, so all of 2020. And it gives us a low point on January 13th, right over here, of 11.75, well below 15. And then 2 months later, we hit our year high VIX right up here at 85.47. Now, those are a couple of days. Let's talk a little bit more generally, where a stable VIX is anything below 15. To give you an idea, in 2019, the average VIX was about 13.5 to 14. In 2020, the average VIX was 29.25, over double what it was last year, and almost double what we consider to be a stable market volatility. But that's not all bad. Keep in mind that volatility is not the doomsday index. It's not the idea of if volatility is high, everyone's losing their shirts and losing their wallets. No. Volatility just tells us how much change there is, how much is happening. The prices could be skyrocketing, and if things are going straight up, volatility is still going to be high. Just like if the market took a tumble and crashed, volatility would be high as well. But just because we have high volatility doesn't mean the market is doing poorly. In fact, we saw and are currently seeing the market reach levels that it's never reached before. New highs for the Dow, for the S&P 500. And this is amidst a VIX that has consistently been over 20 throughout the entire year. So just because the VIX is high doesn't mean the market's bad. So please keep that in mind. Now, let's look at our actual market sectors. So to look at market sector leaders, here's what we've done. We've gone through and grabbed the matrix from the first of every month in 2020. So January 1st, February 1st, grabbed all of the different months and all the different matrices, and then stuck them all together. So what we'll do is we'll take the total count column from every single month, and then we're going to put that on a nice graph so that we can look at how each sector changes over the course of the year. And to give us, because I'm going to show you quite a few graphics, I want to show you one thing that you can remember that will not change throughout all the charts. That will be the average. So what I've done is I've taken all of the total counts, added them up, divided them by 12 because that's how many sectors we have, plus the S&P 500, and that will give us the average for that month. And these averages will be on all of the charts that you'll see today so that you can give that as a point of comparison if needed. But I've talked too much about words. Let's go look at what a picture of this actually looks like. Ta-da! It is a lot of information, but let me try and make this a little bit more clear. Each column, each up and down, is 1 month. And the number that you see is the total count for that sector. Now, each total count will be out of 22 because each chart has 11 comparisons. Each comparison has 2 values, positive and negative, or X and O. So the highest you can have is 22. The lowest you can have is 0. So the average, you would think, would always be 11, right? Half of 22 is 11. But that's not always the case. So this black line will always be our average. So that black line will be in all of the charts I show you, and those numbers will never change. And we can see during different periods of time, such as March, when we saw that giant volatility spike, that's also when the US started going under lockdown because of COVID, and the market really started to suffer. We see that happening with all the different sectors, all taking a big dip, and our average of our relative strength going down from 11 to 7. Then we recovered and bounced back up, then dipped a little bit, and it's been around 11 and 10. It's dropped down to 9, but mostly it's been around normal. There hasn't been anything like March and April in the market that's happened since. So there's a lot of information on this chart, but we'll break it down over the next couple of slides. However, I encourage you to go back either right now or at the end of the presentation or another time and pause on this screen and look at the information for yourself and see what you find interesting. There is a lot of amazing things that you can find in this chart. So what I will do today is I will show you what I saw, the cool things I saw. And then I encourage you to go back and do the same. And if you find something that you think is really interesting, please send me an email at support@sectorsmadesimple.com. I would love to hear from you what you thought of 2020 in the matrix and what information you found important or meaningful in these charts. So let's break this down in the easiest way I could think of. We're going to break it down by defensive sectors, middle of the pack sectors, and then our super sensitive or our cyclical sectors. So these are terms that we've covered in a members webinar before. So members, if you'd like to learn more about what these terms are, please take a look at that webinar. But for everyone else, I'm just going to give a very, very quick explanation of what they are. A defensive sector is one that will tend to do pretty well even in bad markets. Now, these are sectors that, when everything goes crazy, these are the ones that you can usually think of as being the most stable. And they'll include staples, healthcare, not the company, the category. So things like your general needs, your toilet paper, your towels, your soaps, all that. Healthcare and utilities. These are going to be some of the best performing sectors in shrinking markets. But more importantly, they're also the sectors that if things get really bad, will see the least amount of effect. So let's go look at what that looks like in 2020. Can't see the bottom?
It's a little cut off.
Strange. Let me see if I can fix that.
On the graph, you can't see what all the different little markers are.
Let me see if I can fix that really quickly. Oh, I broke it. Sorry, bear with me. This is why I'm not allowed to play with the technology toys. I break them. Properties. Nope. Why is it not showing the background? Or why is it not showing the bottom?
Well, we can see everything on this screen.
Yeah, it's going to be the next slide that the bottom gets chopped off. Yeah, that's unfortunate. All right, so yeah. Transform. Got it. All right, cool. Sorry about that. Now everyone should be able to see what the different labels are. I apologize for that cropping issue. So let me go back to where I was before. So here what we see are the defensive sectors. These are going to be XLP, staples, XLU, utilities, XLV, healthcare, and again, our black is our average line. We see that in March, things got hit pretty hard, and our defensive sectors were no exception to that. But when things got hit hard, they also didn't tank. They didn't get hurt horribly. They managed to hold on, with the exception of utilities. Utilities is a sector that had a miserable 2020 of having a BPI of 0% for about a month and a half. Now there's two sectors that reached 0% BPI throughout 2020. Real estate and utilities. But utilities especially has been a sector that has been very volatile throughout 2020, despite being considered to be a defensive sector. This goes back to something that I've mentioned in the past, but I feel is worth mentioning again today. That just because a sector is defensive doesn't mean that it is immune to having large changes. Sectors they don't follow a textbook. They follow the real world and real world events. So because of that, utilities is a sector that was hit very, very hard through the recovery out of COVID. And we see this very clearly where while staples and healthcare both skyrocketed in April, because what was one thing that everyone wanted in April? Everyone wanted their toilet paper, and everyone wanted some good news about a vaccine in the development. So those two sectors skyrocketed because of the conditions of what was happening. But no one was looking at utilities saying, hey, well, what about you? What are you doing? Didn't happen. So utilities got hit very hard, and over time, we see that both staples and healthcare, as the market stabilized, kind of fell back into more or less not being so much sector leaders and more kind of being stragglers in the pack. Now, let's look now at the middle of the pack sectors, and this is where the story starts to get a little bit more clear. These are sectors that will be affected by changes in the economic cycle and can be indicators of when things start to change. But we didn't need a sector rotation to tell us things were changing. Things changed and the sectors kind of just changed along with it. But I want to list these out for you. these sectors that are considered to be middle of the pack, neither volatile nor stable, are communications, energy, industrials, and technology. So these are those four sectors, again, with our average. And we see that technology in yellow had a crazy 2020. It had months of clear sector leadership and then got hit really hard in March and really hard in November. COVID and the election hit technology like a freight train. But despite that, all of the other sectors did have their ups and downs, but by no means were this giant jagged line that some other sectors could and were. So here we're seeing the middle of the pack sectors being just that. They bounce between kind of being around the 11 mark, jumping up, but not having any massive changes besides energy's spike out of the COVID crunch and technology's dip into the crunch as well as into the election and recovering soon after. Now, we get to our super sensitive or our cyclical sectors. These are sectors that are highly affected by changes in the economic cycle, and these include materials, discretionary, aka consumer cyclical, wonder where they get their name from, financials, and to a certain extent, real estate. And here are those sectors. We see that coming out of March, these sectors were all hit pretty hard in March, but were the first to recover and skyrocketed out of the March crunch. And we see from there, things have kind of separated, where we've had massive changes for sectors such as financials, from 4 to 13 in a single month, compared to building materials 1 to 11, right up to 15. And all of these massive changes are happening very, very quickly. So this is where we see that cyclical or rapid cycling nature happen. We see that these sectors can change leadership in a month or two, and that their changes will be very, very large. So I want to stop looking at a bunch of crazy dots on a graph, and I want to give us something very, very simple to look at, but something very meaningful. Top sector every month. Now comes the awards ceremony. We get to give the awards for the leader, and we're not going to give participation awards today. We're just going to give first place. But let's see what each of the top sectors were in every single month. Remember, these are not over the course of the month. This is just on January 1st, February 1st, March 1st, so on and so forth. January was technology. February, technology. March, this is where we saw technology take a big hit and communications stepped up. April, people wanted some good news about a vaccine. Healthcare tried to give them what they wanted. May, technology. June, discretionary, jumped up to leadership. July, discretionary. August, discretionary. September, technology. October, technology. November, communications. And December, materials. So there's not a clear line. Go figure, real life never really is going to be a clear story. There's too much going on to just give one reason or one explanation for everything that we see. But something that is clear here is that there is a trend. Technology, discretionary, still technology, and now communications and materials. So keep those four names in mind. Technology, discretionary, communications, materials. And now let's look at our leading sectors in the realm of cyclicality, the market cycle. Using the market cycle, let's take those 4 sectors that we just named: technology, discretionary, communications, materials. Technology, discretionary, communications, materials. Right there we see the 4 sectors that we just talked about, one after another, leading us from this point on the chart, full recession market bottom, into an early recovery bull market. Hey Maida, good to see you. So using the market and economic cycle, we can guess or estimate that because of all of the changes that happened in the market, keep in mind that the economic cycle is something that happens over years. This is not a couple of month thing. This is not something that will happen in a single year. We tend to see market and economic cycle changes over years. But because of the increased volatility of this past year, we have a much faster cycle. And we see that being the leading driver of these sector rotations, where we saw technology, then discretionary. Technology was still doing pretty well, but then came communications and materials. So we move from a full recession market bottom, moving into an early recovery market. Let's now take those 4 sectors. You know what? We'll add industrials too, because industrials is in the middle there, but we haven't really gotten to talk about it too much today. But that doesn't mean that it's not doing something. So technology, discretionary, communications, industrials, and materials. Let's see how they did in 2020. So remember, the first sectors that we would expect to be the leaders would be discretionary and technology. And that is what we see here. The purple is technology being the clear leader. Discretionary is doing a bit above average, then a bit below average, but goes from there to taking over as the sector leader for a period of about 4 months. So we see that cycle, we can't think that that's the only thing going on, but it is and was a key driver in the events of the market in 2020, where technology was the leader, then became discretionary, and technology had a nice little moment in the spotlight again, but really we see a constant trend here upwards for communications, and to a bigger extent, building materials, going from a sector with 1 in March, jumping up to 15, correcting back down, and having a steady incline from there. Remember, if we're going to see changes in the economic cycle, they're not going to happen over a few weeks or even a month. These will be long-term changes that will happen. So think of it like this. You go to the beach and the waves are coming in and out. That's the normal events. That's the market just doing its thing. So you're sitting there nice and relaxed on the beach. You've got your lawn chair set up. You've got your drinks and your food out. You're having a great time. The waves, they're getting close, but they're still far enough away from you. The tide is the economic cycle. The tide starts coming in. You dozed off and took a nap. The next thing you know, the waves are now underneath your beach chair. Your food is now being eaten by the seagulls and the fish about 30 meters out in the water, and you're now looking for where all of your sandcastle building materials went. Because there was these little waves over time. That is what this little bouncy thing is. It's the up and down that will happen in the market. But no matter what, that tide is still coming in or that tide is still going out. So that is what the economic cycle is. It is that current underneath all of the waves, that it doesn't care that the waves are doing their thing, because that is bigger than just the market. That is the entire US economy moving. So that is something that we see here. We see that the entire market shifts from early recession to recovery, moving into 2021. And again, 2020 was special that we got to see such a big change happening so quickly because of increased volatility. When volatility is lower, the tide moves a little bit slower because there's not as much going on. It's not as crazy. So what we can tell here, though, is that while it's not a clear-cut line, because the waves are what you notice. You don't notice the current. You don't notice the tide. You only notice the waves. But when we look at it a little bit more in depth, yeah, I can see the tide coming in here. So while it's not a very straight line, we can see the trend happening. And technology has maintained its strength throughout the year. Now, there could be many reasons for that, not just a single thing going on. There could be, for example, Zoom. Zoom is a communications and a technology company that, because all of us are now at home doing our work from home, Zoom's going to have a little bit more business than they might have if everyone was still going to the office for their 9 to 5. So we'll see that happening. Now, other sectors, such as materials, have been heavily moved by the economic cycle, where a lot of their movement was not due to something like Zoom. We don't have a materials equivalent of Zoom or of Tesla or of any of these large movers in the market. What they do have is the market cycle pushing them forward. Now, seasonality is a bit of a different story. We just talked about something that happens in years, 3, maybe 5, even 10-year cycles. Let's now talk about a 1-year cycle that we like to call the calendar. January, February, March, April, November, December. Seasonality. And this is what seasonality, according to the website Equity Clock, looks like. We can see that during different periods of time, we would expect different sectors to be performing well. Now, I will save a little bit of time here, but also I will give you my opinion of what I see. And what I found is that there is no story here. Seasonality did not have a big role, didn't do a lot in terms of what we saw for 2020 sector rotation. Reason being, there is no definition, there is no textbook that says why energy between August and September does well. Just like there's no textbook reason that from July 23rd to October 3rd, utilities does well. This is information that we've figured out by looking at things over many years. So these are based on the past 20 years of stock data, of sector data. Last year is not like 2019. It wasn't like 2018. It's unlike any year we've had, because what we did how we lived our year was so incredibly different to every other year that the reason we see something like this is because we're predictable. Sorry, hate to say it, we're a little bit predictable. We know that lunch tends to be sometime around noon. We know that people like to take their vacations during the holidays to visit family and during the summer because the weather is nice. But 2020 wasn't like that. How we lived 2020 was completely different. And because of that, seasonality, or how the market has responded to different months and has evolved through the year, is completely different. So, because of that, we can't really look at the traditional, and by traditional, I mean this historical seasonality, to apply to 2020. We weren't taking our large vacations with the family to go to Florida in June, July. We weren't having the big get-togethers. Things changed. One thing's for sure, consumer staples, yeah, we all still needed our toilet paper, but how we lived 2020 was completely different. And as a result, we can't look at something like this and expect it to tell us how or why the market did what it did. So now I want to talk about 2021, because I've covered everything up through December 1st of 2020. How about January 1st? Well, January 1st was Friday and it was New Year's. So I'll give you the next best thing. This was the matrix on last Wednesday. Or Thursday. My apologies. This was right before New Year's and the last matrix of 2020. And here we see our sector leadership once again. Technology, because it doesn't seem to want to get the memo, still continues to be a leading sector. However, that was not the case for all of December. It wasn't until about December 15th that technology started picking up steam. And over the last 2 weeks of December, technology rose from a total count of about 10 up to 20 to become our new sector leader. But behind technology, we see a little bit more of a clear story. Communications, building materials, and industrials are three sectors that the market cycle says should be the leaders. Then, behind that, we have our super sensitive, or the sectors that when things start to improve, they're the ones that are going to see that improvement the soonest. That is going to be financials. Financials has started to gain a lot of short-term strength, but compared to all of the other sectors that it's grouped with, here we have 11, 7, 8, 9, 7, even discretionary down at 6. Financials is still at 4. So it's having a good week, it's having a good month, but it's short-term gains. So it'll be interesting to see what happens with financials, because everything else up here, there is a very clear reason as to why. The market cycle says it, and we can expect it. But financials is gaining a lot of short-term strength, and it'll be curious to see what it can do from there.
I don't know if you're still doing those or not. But
Mm-hmm. So that is about all I had for you all today. I wanted to share with you what 2020 looked like, how it's changed, how the economic cycle was the most clear change in the market. But there's more to it than just that. And sadly, I can only show you the beginning of it because there is no one simple answer to it. There's probably no three answers to it. There is hundreds of reasons and thousands of reasons why the market did what it did in 2020. But the one thing I can say is this. 2020 was crazy for sectors because ETFs were something that you could invest in like a normal stock almost. Its price changed quickly. Prices in general changed very quickly when volatility was very high. And because of that, ETFs were an investment that you could do in the short term. They were hold it for a week or two, it'll go on a double top breakout, hold it for a little bit, and then it'll drop 10% like a normal stock, and you sell it with your trailing stop. 2021, fingers crossed, is not as crazy. It will be a little bit more stable. And because of that, these ETFs have gone back to being a little bit more boring, let's say, because it is an opportunity to buy something that is long term. It is something that won't change every day because the sector leaders are not changing every day. Yes, there will still be sectors that jump and drop, but we are seeing a return to the very standard principles of the economic cycle can give us an idea of who is going to be the strongest. There will be the financials in there that have a good period of time, but even then, it still is odd. When you look at the numbers, it doesn't match up. It doesn't fit in. All of these others are pretty balanced. 11.9, 7.9, 8.7, 9.5 is weird, and 4.9 is weird. So it will be interesting to see how this evolves between the economic cycle leaders of communications, building materials, and industrials, and the market and social leaders, which right now have been technology and financials. So that is what I wanted to share with you all today, is what I saw in 2020 in sectors and how I feel and the main drivers that I saw for the movement that we saw. Of course, there's a lot of things that went on besides just the economic cycle changes, but that's the story for today and the story for the past year. Does anybody have any questions? Yes. Mario and Elizabeth, por favor, envíame or Jacqueline, my apologies. Por favor, envíame un email para recibir el cupón por eso. Does anybody have any questions about what we've talked about today? When you buy a sector, how long do we keep it? Good question. And it depends. Because sectors are no longer crazy volatile like stocks would be, or more volatile like stocks would be, you can make a case that sectors can be something that you buy and hold like you would a more long-term investment, where you're buying a sector for the long term because the prices aren't changing every day. but it really depends on the sector. For example, financials in the past week had a couple of days that the price went up 4-5% in a day. Same thing with energy. Energy had a couple of days in the past week when it went up 3 to 5%. So certain sectors will have a lot more movement, and those will tend to be our more offensive sectors. If we go back here, materials, discretionary, financials, and real estate are typically the ones that we will see have the most price changes in a shorter period of time. So this is where there may be a little bit more opportunity. However, there's nothing to say that someone like technology isn't a good investment, because technology has shown that it has maintained its strength over a long period of time, and because of that can be looked at as a little bit more of a long-term investment. Victor is asking, in your experience, how much is a good percent to make in your money on an average? That is really difficult to say because it's not good to compare a flat percentage. I would recommend comparing yourself or comparing your returns against the S&P 500. Because remember that you always have the option to invest in the SPY, the S&P 500 ETF. So your goal should be to try and beat the S&P. And if you're outperforming the S&P 500, you're doing well. So that should be your goal in that. Hmm. What do you think about KB&E? It's a financial ETF. I do not know enough about KBE to really say. I apologize. How do we look at companies that are in a sector that are a little boring? How do you look for companies that are in a sector that are a little boring? I recommend going through and going to FinViz and applying Be a Profit to a leading sector. So once you find a leading sector, go in and find companies with strong fundamentals in that leading sector that could be potential investments. If you're curious about a good way to do that and you are a Sectors Made Simple member, our second members webinar, I believe, is on fundamentals and Be a Profit with the matrix. So that video will show you how you can take the information the matrix gives you and take the leading sector and then look at that.
Did you see how much some of these people have made?
So if there are no more questions, then I think we will call it here for today. Let me just make sure I didn't miss anybody. Awesome. Well, thank you all so much for joining us. Happy New Year. Welcome to 2021, and I look forward to a fun filled year of investment knowledge and education with you all, and lots more matrix information to come. We have a lot of fun things planned for Sectors Made Simple, including a new strategy for you all to learn from, a new backtesting engine to see how your strategies would have done. And if you have any questions, like Kira said, about the coupons or anything else, please shoot me an email at support@sectorsmadesimple.com. The app is still going right now. We are just waiting on one or two things, but hopefully should have that done here in the next week or two. But anyway, thank you all so much. It's been a pleasure, and I will see you all bright and, well, not so much bright and late or early, but bright and late next Friday. Or for members, I will see you all in our class on Tuesday. Thank you all so much for joining us here today, and we'll catch you all very, very soon. Have a great weekend, everyone.